An active investment is something that you have to participate in on a regular basis in order to produce the return that you're hoping from that investment. A passive investment is something that you don't have to participate in on a regular basis, and it just works on your behalf in the background, and it still produces the return without you doing much effort. So let's jump in and look at several different types of investments and whether those are active or passive investments. So first, we're going to start talking about stocks. This could be in the stock market. There's many different kinds of stocks and different ways you can buy into the stock market. And we're going to separate them into growth stocks and income stocks. So a growth stock is something that you buy in, maybe a younger company that is doing really well or has the potential to do really well. And you're hoping that you're going to buy the stock at a lower price and eventually sell the stock at a higher price so that you can get the return that you're expecting. Now, a growth stock could be either an active or a passive investment. If you wanted a growth stock to be an active investment, you as an investor would be selecting the stock on your own. You'd be watching it on a regular basis. If it goes up, maybe you choose to sell it. Or if it goes down, maybe you choose to buy more of that stock. Now, if you wanted to use growth stock as a passive investing strategy, you might look at doing something like a mutual fund or an ETF so that somebody else could be managing that on your behalf. But even if you're in that type of an investment, you still need to be monitoring it. So it's sort of passive, but sort of active as well. Now, there's also income stocks. And actually, before I jump into that, you would be using a growth stock to help grow your wealth faster because you have the expectation that the return will be higher than maybe an income stock. So with a growth stock, there's a higher level of risk. And with a higher level of risk, you expect or hope that you'll get a higher rate of return. Now, with an income stock, you might have a company that is not old, but is very established and is producing a really great amount of revenue on an annual basis. And because of that, they're able to pay out distributions or dividends on a regular basis. And you would use an income stock if you needed more cash flow coming into you on a regular basis. But with an income stock, you're going to be getting most likely a lower rate of return than a growth stock, because in theory, there's less risk involved. And with less risk, there's generally less rate of return. So that's a quick overview of stocks. We're going to jump now into bonds. Bonds are a great vehicle to get passive income because you're basically purchasing something that has an interest rate tied to it, which gives you payments on a regular basis. So this would be a great option if you were looking for passive income because you could buy a bond and it would pay you out on a regular basis a certain amount of money. So this could help if you need that monthly or quarterly cash flow. A bond is a great investment for that. Bonds generally have a lower rate of return because they are less risky. We're going to talk about real estate as an investing vehicle. Now, if you don't know this, there's many, many different ways you can invest in real estate. And for this quick conversation, we're going to be talking about two options, and that is flipping homes or rental real estate. Now, when it comes to flipping properties, you could be flipping single family homes, you could be flipping commercial spaces. There's many ways you can do that. The point is with flipping property, for the most part, that's a very active investing strategy. There's things that have to be done almost every day with a property flip in order to achieve the return that you're trying for, because the faster you can do the flip, the less time your money is at play, the greater return you have to potentially make with that investment. Now, you could have flipping homes be a passive investment if you were to partner with somebody else. So maybe I partner with Roger to flip homes. He does most of the work, but I provide a lot of the capital. So in that scenario, I could be a passive investor in flipping homes, but for the most part, that strategy is an active strategy. So keep that in mind. You could be active or passive when you're flipping homes. Now, we're going to talk a little bit about rental real estate. And if you're not aware of this, the three people on this podcast, Roger, Earl, and myself, we run an investment real estate company, and we focus on multifamily or apartment buildings. So we have a lot of experience in the rental real estate industry. And one of the common misconceptions, and we're going to talk about this quite a bit today, is rental real estate. A lot of people think it's a passive investment. You just buy a property, you have a tenant in there, they pay you every month, you make money. Seems pretty simple. The sad truth is that rental real estate is very active. There's a lot that has to be done on a regular basis, and there's a lot of cost that plays into it that can really affect your rate of return. Now, one of the things I try to talk to people about when we're talking about rental real estate is that it really needs to be treated as a business. And you could say the same thing for flipping homes. It really needs to be treated as a business because there's income, expenses, there's operation pieces, there's marketing, there's a lot of moving parts that have to be done well in order to get the rate of return that you're expecting. So if we're talking kind of a comparison here, if you're buying stocks, you're not in control of how that investment performs. You're basically saying, I think it's going to go up, so I'm going to buy it, or it's gone up, so I'm going to sell it. That's the control you have. With real estate, you have an opportunity to have a lot more control, which is good and bad. Because if you're good at it, the control can help you produce a much higher rate of return. But if you're not good at it, your return could be really low or it could be negative. There's a good chance you could buy real estate and lose money if you don't know what you're doing. And for the most part, if we're buying investments, we want to make money, not lose money. So with rental real estate, if you want to be an active investor, you could go out and you could buy a property that's a rental. That could be a single family home. It could be a duplex. It could be an office building. Like there's a lot of different ways you can invest in rental real estate. And if you want to be doing the day-to-day management, you could be an active real estate investor. Now, there's another opportunity where you could be a passive real estate investor, which means you partner with somebody in some fashion where you invest your capital in a project that somebody else is operating that has the expertise, and they're able to do that and produce a higher rate of return. We're going to come back to this as well, but as far as risk and return, real estate has, in theory, a higher risk level, which means you could and should be expecting a higher rate of return from that type of investment. Now, the last category we're going to talk about for the moment is small businesses. If you don't know this, when you invest in a stock, you're really just investing in a business. Most of those are much larger, more established companies that have gone public, and that's how you're able to invest in that stock of the company. You also have, or you might have the opportunity to invest in a small business, which really just means you're buying a stock in the small company. And one of the advantages to buying stock in a smaller company is that you can get in at the ground level, which means you're buying a stock or a share in that company when they're just getting started. And that can be really beneficial because if you put in a small investment into a small company and then they do really well and their profits go up exponentially, when you cash out, the return can be really large. But it's also really high risk because that company could fail and you could lose all your money. So there's, again, the risk reward balance that you have to be dealing with as an investor. And with a small business, you could be either an active or a passive investor, kind of similar to the real estate option, because if you, and this goes back to what we talked about in the last episode with the cash flow quadrant, this is the B category, the business owner. You could be a business owner yourself, such as Earl, Roger, and I have started a business together. We're actively involved in that business. But you could also be a passive investor in a small business where you put some of your capital into somebody else's business and they do the work, but your money is at risk. So that is how you can be a passive investor in a small business.